Today we're at A+ Credit answering all of your credit questions. Be sure to click on the link below to download 10 credit tips that you need to know. Hi, and welcome to LexHomeHub.com TV. I am your local Lexington Realtor, Morgan Franklin, and joining me today is A+ Credit, and we have Karen Scheuerman and Chad McCullough. Welcome to the show, guys.
Thank you.
Glad to have you here. So, Chad and Karen run A+ Credit here in Louisville, Kentucky, and they're going to talk to us a little bit today about why is credit important. So I guess, guys, take it away. Tell me why your credit score is so important.
Well, your credit score is very important because whenever you go to apply for credit, whether it be a loan at a mortgage company or at the bank, of course, they're going to want to pull your credit and see how risky you are to be lended money to. That's what the credit score is all about, is how well do you pay back money. So they'll score you based on your past history of that. So they take into account all of the good accounts, the bad accounts, are there collections, are there paid collections, are there judgments, liens, all sorts of things, of course, and how deep does your payment history run. So they take all of that into account, and they provide a score, and hopefully that score is high enough so that you can get the loan.
Okay, so you got to have a good credit score to get financing, to get a mortgage, to get a car, to get a credit card, to get a lot of things that you want in life. So what is a good credit score? Like, what is the range of credit scores, and what defines good?
The range of credit scores is anywhere from 300 points to 850 points. And so what we're talking about is FICO scores. There's a lot of different scores on the internet, and we'll talk about that here in a bit. But FICO stands for Fair Isaac Company, and it runs from 300 points to 850 points. And to be able to get a loan, a mortgage loan in today's day and age, you'll need at least probably 620, 640. The national average is probably, I'd say 660. But I'd say 680 credit scores is good. Anything above 720, 740 is excellent credit. You'll probably get the best rates. Anytime that you dip below 600s, then we're talking about pretty damaged credit.
So you said Fair Isaac is a FICO score, but I've heard about Experian, TransUnion, and Equifax. You know, are they FICO? How does that work?
Those are the three credit bureaus that provide scores.
Okay.
So they have all the algorithms that they take all of your information from your past and they plug it into their computers and it provides this number. So in the three credit repositories are Equifax, Experian, and TransUnion. So they're the ones that provide these scores that banks and mortgage companies, auto dealerships would use.
Okay, so they use the FICO methodology to calculate the score.
Exactly.
Okay, great. So now we know what a credit score is and what a good credit score is. So what affects my credit score? You know, what gives me a good score? What gives me, I guess let's start, what do I need to be doing to have a good credit score?
Well, you need to be actively using credit, okay? So if you haven't used credit in a long time, you'll end up becoming what's called a no score. They just won't have enough information on you to score you. So you need to, go ahead and borrow, take out an auto loan or whatever. Things that are not going to affect your score that people think will are things like your electric bill. Your rent usually is not reported unless it goes bad. The same with the electric and all that. But you need to use credit, and you need to use it well, and make sure that you don't become a no score. You need to try and establish some length of credit history as well. And the main thing you need to do is be on top of it. Be aware of where your credit is, what's on it, where are your scores, so that when the time comes that you do want to buy a house, you're not unprepared. So you need to be ready.
So where should I go to get my credit score?
The only place online that you can get an actual FICO score is myfico.com. Okay.
Is that a paid service?
Yes, you're going to have to pay for those scores, but it won't be a hard hit to your credit, but you will get actual FICO scores. You can go on sites like Credit Karma. There's a lot of them out there, and you can get an idea of what your credit score is, but it won't be a FICO score.
Okay.
So then there can be a wide range there between that score and a FICO score.
So if I go online and I get my FICO credit score and I see it's low or I don't have any credit at all, what is your advice to somebody that's trying to establish credit? What should be the first thing they do to get that credit score established?
I would say first get a secured credit card. If you if you don't have a revolving account on your credit report, and a revolving account is like a credit card or a store account that you might have at Target or Home Depot or something, those provide a lot of information to the credit bureaus in order to provide you a score. So everybody should really have a revolving account. So even if it's a little secured credit card from your bank that you might have to front a couple $100s to be able to get, but then you'll have a $200 limit credit card and you go charge maybe lunch on it once a month and pay it off.
So a secured card means I've got some cash on hold at the bank, maybe in a CD, and then they give me a credit card equal to that amount. Is that correct?
Exactly.
Okay, so go talk to my local banker to get that line?
Yeah, absolutely. Otherwise, there's other companies online that provide secured credit cards as well.
Okay. And if people have any more questions, I'm sure we'll provide your contact information. They can call you guys and ask for advice. So, you know, being a realtor, you know, obviously I'm engaged in finding mortgage financing on a regular basis. So if I know that I want to buy a house in the next, say, 6 months to a year, what are some steps I need to be taking to make sure that my credit is the best it can possibly be? You know, what are some actions I can take now to make sure that when I find that dream house, I don't go to my mortgage lender and find out that it's not an option?
Yeah, well, again, you want to know where your credit scores are, okay? And you can always talk to a loan officer, okay, and find out, start trying to get it, you know, pre-approved and all of that. One thing that people do make a mistake with is they think, you know what, I'll go online, I'll find out what all my collections are, and I'll just start paying them off. And actually, that can hurt your credit score, okay? And
What?
Yeah.
Paying off your debts will
Yeah,
hurt your
it
credit
actually
score?
can. Yeah, if you pay off some 5-year-old $25 medical collection, kind of re-ages it and makes it a little fresher than it used to be.
Really?
And it can actually hurt your scores. We've unfortunately had people that have gone out and paid $4,000, $5,000, $6,000 worth of collections off, and their scores have dropped. Partially because they didn't rebuild credit, you know, add some new active credit. That's helpful too. And partly because we help them, you know, part of what we do is we help them target which collections are going to make the most sense to pay off to help raise those credit scores, and which ones actually could lower it. So it's amazing.
Wow.
Yeah, people have spent a lot of money and gotten nothing out of it. So.
I think I'd be very upset if I
Yeah.
paid off a $1,000, you know, collection and then found out that it damaged my score.
It's amazing. Yeah, people don't know that.
I can only imagine.
Yeah.
So that's kind of a perfect segue into my next question. So I hear a lot about credit counseling and credit repair, and you guys are credit repair specialists as opposed to credit counselors. And obviously, you know, you've just demonstrated your expertise and you know what you need to pay off to improve your score. So kind of walk me through what a credit repair person is versus what a credit counselor is, and then I kind of want you guys to tell me about what you guys do. So repair versus counseling.
Yeah.
Sure. Let me explain what credit counseling is first. That's essentially when you have, let's say, a lot of credit card debt, and you'll have that company take over the payments of that so that they can help you lower your monthly bill with it, okay? And which is really completely different than what we do to restore or repair credit scores. The credit counseling piece will oftentimes take all of your bills, let them go behind about 4 months, so that then that way they have leverage to be able to
Where you can't get financing anywhere else.
Yeah, it trashes your credit, of course, but then what that does is buy them leverage so that they can you know, help negotiate down your monthly rates, of course. So what we do is restore credit or repair credit in efforts to be able to help improve the scores by working through a variety of federal law that's out there to help protect consumers and dispute and contest some of the negative information that could be on the report. I mean, by law, by federal law, there cannot be any inaccurate information, incorrect information, incomplete information, duplicated, triplicated. None of that information can exist on a credit report by law. And so what we do is work through the credit bureaus, which is Experian, Equifax, and TransUnion, and you know, help to correct some of that. Oftentimes there's errors on a credit report where, let's say that you have had a collection, you paid it 2 years ago, but it still shows unpaid on the report, which is not really that helpful for your credit sometimes. Or maybe there's been a 30-day late reported on your store account, but you weren't really 30 days late, and you have proof for that, but it's on your report and it's bringing your scores down. So those are the things that we help with to be able to help raise the scores and also help our clients reestablish credit, which is very, very important to be able to help improve scores and get it back into decent credit range at least.
So basically the difference is a credit counselor makes loans that may or may not be in your best interest, and you guys are experts and understand all the laws, and you know how to improve credit scores because you understand the way FICO credit scores work. Is that correct?
Right.
So anybody that has a question, even if they want to work with a credit counselor, should probably speak with someone like yourselves to understand the implications of everything they're going to do, right?
Right. Yeah, absolutely.
Awesome.
Yeah.
So, and I have another question. This one's kind of interesting. So tell me about credit cards. I've heard about revolving lines of credit should be less than 30%, less than 50%, less than 70%. You know, what would really improve a credit score if you had a maxed out credit card? Where does it need to get paid down to?
You know, under 50% is helpful, under 30% is the goal, and then under 20% is even better, and 0 is awesome.
Yeah.
Okay, so the lower the better, but definitely you want to get under that 50% mark, and that's a good way to try and set goals for yourself too.
Mm-hmm.
Okay, let's get it under 50%, then let's work on getting it under 30%, and then under 20% and keep going. And, you know, but you do want to keep them active every once in a while. You do want to use them every once in a while. I don't love credit cards. I keep 3 of them, you know, open and active just because it's good for my credit.
Yeah.
And I charge something on Amazon every once in a while on them or whatever, but everybody does need to have some activity on them at least occasionally just to keep them active. But the lower the better on the balance.
Well, and revolving accounts play in 30% of a credit score.
They're big.
Really?
They're
So
big.
that's almost a third of your entire credit score is how you're using revolving accounts. And so, and what that means is that if you're maxed out on, let's say you have 3 or 4 cards and you're maxed out on them, if you pay those down, that'll absolutely jump your scores. It's tough to tell, but somewhere between, I mean, significant. It could be 30, 40 points if you pay them down underneath the 30% or 25%, because the way that credit is scored, they'll take a look at each individual card and look at the balance to limit ratios, and then they'll add them all up together and figure out the aggregate totals of the limits versus what the balances are, and it plays in heavily with the scores.
So you said revolving credit makes up 30%. What makes up the other 70% of that score?
Payment history,
Okay.
meaning how well do you pay back your loans,
Yeah.
you know, per month. I mean, that's why, you know, if you go late on a car loan for 30 days, it'll drop your scores quite a bit,
Oh,
of
absolutely.
course. And a lot of people don't take that into account. Sometimes they think, well, it's okay. I was late one time, so it doesn't bother, you know.
Yeah, it was
won't
only
bother.
$25.
It won't
I
bother my
doubled up the
scores.
next month. It's okay.
So the amount of the late doesn't matter. It's just the
Yeah.
fact that it's late.
Right.
Yeah.
Absolutely. And so, you know, when it comes to other parts of your credit rating, the history of how long you've had these accounts plays in 15% of a credit score. So that means if you've had a credit card for 15 years and it's got a really high limit on it and a very low balance on it, that's a great card to have to be able to help generate high scores.
Now, you know, I monitor my credit very regularly, and every time I look at my credit score, one of the remarks is credit history not long enough, and everything except for a recent mortgage has been open for longer than 5 years. Why in the world does it say credit history not long enough?
Hard to say. I mean, they like to see some long history.
Yeah.
You know,
that
and-
just blows me. You know, it doesn't. I'm not like boiling mad. I'm
I
just
know.
like, what's wrong with you guys? Come
I
on.
know. 5 years really isn't that long.
Yeah?
You know, it really isn't. You know, they're looking for, I mean, 10 years is great. And, you know, the older you are, the longer your credit history will probably be. So, you know, youth does play against you in that case.
So it would probably be a good idea for an 18 or 19-year-old to get a secured credit card and start using it responsibly.
Yes.
Right. That's the key.
Yeah.
No trips on spring break going to Cancun on the
Right.
credit card.
Right. When we see that a lot, that college kids are
Yeah.
offered a lot of credit cards and they don't know how to use them and they go bad and now they're 25, 26, they're wanting to buy a house. And we see that a lot, you know.
Oh,
so,
I signed up for 2 credit cards when I was in college for, I think it was a couple extra large pizzas from Papa John's.
yeah.
Still have them.
Yeah, well, that's good, you know, but if they're good. And the thing is that when that late payment initially hits the credit report, it drops the score hugely. And
Yeah.
I mean, we've actually seen it drop scores 100 points.
Oh, sure.
And so, you know, and it takes a long time for that to go away, 7 years, you know.
Wow.
Now the damage gets less as time goes on, but that, you know, just missing that one credit card payment, whether it was a $25 minimum or what, it's huge.
And it's also important to know, too, is that I guess it's okay to be somewhat late on a payment, okay, because they all have grace periods. But once it hits 30 days late, then it's going on your credit report for the next 7 years, because that's the statute of limitations with a negative account, is that it'll stay on your report for 7 years before it naturally falls off.
And isn't that the same, a bankruptcy stays on for 7 years, isn't that correct?
10 years,
yeah.
typically.
Wow.
Yeah, because it's a public record, so it'll stay
Yeah.
on there a little longer, okay? And so...
And if people have any questions about that, I'm sure they can give you a ring. Yeah, we're going to wrap this up. Do you guys have anything you'd like to add that we've kind of overlooked?
I would say it's just really important to monitor your credit, because when some negative things could pop on your credit report, and you may not know about it until it's too late, you see? So it's important to stay on top of that. So there's a lot of different free apps out there that you can monitor your credit with. I don't think that the scores are exactly accurate that you can always rely on. I think that when you go to a bank or a mortgage company, a dealership, those are solid numbers because they're FICO scores. But it's important to monitor your credit, it really is. And what was the name of the website you can go to get your actual FICO score?
myfico.com.
Okay, great.
So.
All right, guys. Well, thank you all so much for watching. Chad and Karen's contact information is going to be across the screen in just a moment, as well as in the description below. Please don't forget to subscribe to the YouTube channel, and also visit lexhomehub.com for all kinds of great local videos and articles. Thanks so much for watching, and we'll talk again soon. Don't forget to click the link in the description below to download 10 credit tips you need to know.